Big banks are going to kick off the fourth quarter earnings season. Tomorrow, J.P. Morgan, Wells Fargo, Goldman Sachs, and Citi. Report joining us with a preview is Jason Goldberg. Barclays, which is a bank senior equity analyst. Is it possible for you to study yourself? There are philosophical questions, Kant and Gödel, that it's not possible, really. Philosophically to do this. Should we trust you on this, Jason?
You could trust me.
We can trust you. You have a top 10 list, don't you? Something is going to be seen in all these banks. There are some macro influences, are there not? Such as?
Yeah, absolutely. I mean, certainly, in the fourth quarter, you did see, a further pickup in investment banking activity.
Okay.
So that should be a positive. Loan growth still subdued. So maybe somewhat of a negative. You are starting to benefit from lower funding costs as the Fed reduced rates, 100 basis points in the last 3.5 months of the year. That's a potential benefit. Expenses tend to seasonally higher, so that's a headwind. And then credit quality, remains to be pretty stable.
So with the banks that we just talked about, and over the next week we'll get a lot of them, how do they differentiate with those things that you were just talking about? Who benefits, who's not ready, who's set up properly?
Yeah, I would say the largest banks, certainly benefit from the pickup in capital markets activity. It should also be a strong trading quarter relative to a year ago.
Do you have favorites there?
And then, we continue to be, biased for the bigger banks. J.P. Morgan, Bank of America, Citigroup, Goldman Sachs, Morgan Stanley should all, we think, stand out. And then, one of the big takeaways from the fourth quarter earnings call is the outlook for 2025. And there, you have this new administration coming in. A lot of hope that their pro-growth agenda, leads to a pickup in loan activity, as well as a continued increase in IPO and M&A activity. And then, more broadly, more pragmatic approach to bank regulation, which certainly has stymied capital return and the like.
Do you go into the regionals or smaller banks? There is a lot of positive sentiment regarding the new administration.
Yeah, certainly with the regionals, a little bit more exposed to loan growth, so maybe that's more on the come. I think you've seen corporates are still a bit reluctant to borrow, given borrowing costs are still fairly elevated, and just waiting to see ultimately what some of these economic policies look like. But, one of the themes is you do expect to pick up in regional bank M&A. Some of our banks in the U.S. has halved in the last 20 years, and looking out, we would expect it to have again. We'll see how form that takes. But I think once kind of bank regulation policy becomes more clearer, you could certainly see a pickup in activity, which should benefit some of the regionals.
Since the Fed cut, mortgage rates have gone up. There's an article here. Global bond yields are surging all around the world, including here. How does that factor into 2025? Yeah,
so, kind of puts and takes. Banks do have kind of a lot of low-yielding securities rolling off the balance sheets that they put on 3-4 years ago that now they get to replace at higher yields. So that should actually benefit net interest margins. And at the same time, with the Fed cutting rates, you have seen deposit costs come down a little bit. On the flip side, you should see kind of, you won't see a pickup maybe in mortgage refinance activity. And then unrealized losses, which kind of plagued the banks in 2023, have increased during the fourth quarter and should weigh on book value.
And charge-offs or credit quality or consumer, how about that? I mean, this is not great for consumers.
Yeah, with credit metrics, over the last several years have been relatively stable. You certainly saw loan losses rise kind of coming out of the pandemic after a period of below normal loan losses. But the last 3-4 quarters, you've seen a fair amount of stability. The unemployment rate on Friday, 4.1%, so still historically low. So the consumer, some stress on the low end, but the consumer, if they have a job, they tend to pay back their bills.
So will Goldman, is that the best in terms of I don't know, blue chip investment banks? What is Citi having any progress in what is a multi-year turnaround? Just go into individual.
Yeah, no.
Wells Fargo.
Yeah. So, with respect to Citigroup, clearly a multi-year turnaround effort. Although in the third quarter, they made a significant progress. All 5 of their business lines had year-over-year revenue growth. All 5 saw revenue growth outpace expense growth. So that's the first time we saw that. So it does feel like a lot of the initiatives they undertake in terms of, selling off underperforming regions and restructuring the entire organization are finally starting to take hold. And at the same time, they do have some of these tailwinds of improved capital markets activity, potential for lighter regulatory touch. So we do think they could be a beneficiary as you think about 2025.
Mm-hmm. Morgan Stanley, I don't think we mentioned. Still, quite a a job. Gorman's gone, obviously, or at least chairman, moving over. That's going to continue. That's quality. Wells Fargo making progress.
Yeah, no, I would think, the big banks as a whole, I think have made a lot of progress over the last several years. With respect to Morgan Stanley, Ted Pick took over the start of last year and kind of continued, where James Gorman left off in terms of, continuing to kind of grow, the capital markets businesses as well as the math management and investment management units. And Wells has done, we think, a good job. They still have that asset cap from the Fed that, kind of every year you say this is the year it's going to come off. We think it'll be 2025. They made a lot of progress there, but, we'll see. But
happy days are here again for regulation.
As long as certainly from a regulatory standpoint, after I think we've gotten worse and worse and worse every year since the financial crisis. If you think about a lot of the new regulators that are potentially kind of coming in, they've all talked about taking a more pragmatic approach, a more holistic approach to kind of regulating capital, which I think allows the banks to more effectively, be credit facilitators and just manage their balance sheets.